Hey guys, you're an idiot if you're still trading these stocks. Stay tuned. We got something pretty wild to show you.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Thanks for listening. Hey, Phil, why don't we show people a little bit about what's happening here with the market? And I think it totally pertains to what we've been seeing here for the last 4 to 6 weeks and around these meme stocks. So you want to show them this chart? Pretty cool.
Yeah, so first chart we have on deck here is basically what this is an index of the New York Stock Exchange, so the stock components of the New York Stock Exchange, and how it relates to what we call the FINRA margin debt, which is essentially, people use margin to lever up their cash that they have to allocate to stock trading. And so you can think of it as fuel. And so that's the orange line. The orange line basically acts like fuel for the market. And you'll notice that the orange line there on the right is going south in a hurry. And the turquoise color line is the New York Stock Exchange, essentially, as an index of the basket of stocks in there. And that's, you can tell, is going up much like, it's no different really than the S&P 500 or the Dow or anything else. All these indices are generally going up. So you have this massive like Jaws-like divergence between what the market's doing and what the fuel for the market is doing. And the same goes for the liquidity chart, which we'll show later today in this video. So if you look back on the chart, whenever we've seen the orange line go south and the index line go north, the index line always catches back down to the orange line. So you saw that in 2020. There was a pretty decent divergence going into 2008 as well. So these are massive divergences that are happening. And this one is one of the biggest ones we've seen. So there is a huge risk for a big snap back down. And it doesn't work the other way. It's not like the market goes up and then, the divergence on the orange line, goes back up. It snaps back down first. So extreme probability for a move like that when you take a look at what's going on with the margin debt in the market. And then, Bob, you had a chart, I think it was yield versus treasury.
Yeah, and before I jump on that thing is, you can stay in this chart, is that Tesla now is 24% of all stocks traded today, okay? When I mean today, I mean at this moment in time. And it island topped on Friday, and it dumped at the open today, and it tried to claw back up, but couldn't make it. And as Tesla goes, the market will go, because that is where all the action is. And if that action dries up, those 0TT call volumes dry up, and the market makers are not compelled to buy the entire market because of what's happening here with Tesla, and it's going to roll the whole market down. So if you want a proxy for when this thing is going to implode, you just simply have to watch the Tesla stock. And that's huge. 24% of all shares traded in the market at this point in time are Tesla shares, which is everybody and their brothers just trying to squeeze this lemon to the end. And it island topped, and we talked about that on Friday. You can reference the video on that. And it gapped down again, and it couldn't come back up. So we're on the edge of the cliff, guys. This chart I want to show you is basically saying that you're not getting paid to own equities, bottom line. And with the short rate on bonds, you get 4.85%, I think, on a 3-month bond. You get 5% CD from Capital One, which is FDIC insured for 11-month CD. So you have a situation now where you take zero risk, relatively speaking, against the stock market. And you can see as this thing falls, it just says your risk reward from bonds to stocks is towards bonds. And the pension funds are already leaning that way. They're already trying to push in. Because if you notice, Phil, when there's a treasury auction, there's two components of it. It's called the direct and the indirect, okay? And direct means that institutions are bidding on the bonds, and then whatever get left over is indirect. That means the banks have to come in and slop up the rest. Well, the directs have been going straight up, and that means there's hunger now at these yield levels from pension funds to own bonds. And that's another tell for you that people are kind of satisfied with these rates on bonds and in terms of the risk reward as opposed to owning stocks at this extremely high elevated level. So I want to show you that. And then Phil, I'm going to flip it back to you because it ties back into our euphoria charts again. And I think the market got even more euphoric today while the bankers and the smart money is hiding. You want to throw that up there?
Yeah. So we've shown you guys this chart. Essentially the market again dropped, the liquidity dropped, and it was interesting because today's drop was mostly due to the banks parking more money at the Fed overnight. So you can see below, we're over our euphoric level, and these levels are calibrated just to the current environment of our liquidity from the COVID pump. So until we take all of this liquidity back out of the system, this is our measure of when this market is over its skis. And you can see how, this is very reminiscent of, and I think we talked about this last week, August, same thing. You saw liquidity was not participating in the move higher, and the market can continue to go for a bit, but ultimately, you think of liquidity as the Pied Piper, you got to pay him. So as much like that margin debt chart, you're going to see like we had another condition where we are owed to snap back down on the market. So, you can hang around up here and think everything's honky dory and yeah, it's all bullish. But if you're ignoring the underlying liquidity in the markets right now, you're doing yourself a big disservice. And, and people, you can see it. People are complacent. They don't see, on a day like this, you could see it on Twitter and things like that. People are like saying, yep, we're going to go back and take out the highs. I mean, you could, if the CPI announcement, there's crazy things that happen, you could wick at that high, but we're talking about like the next 2 to 3 days after that announcement. And we have OPEX this week too, which adds more volatility. There's not a lot of fuel. And sometimes this stuff will survive into something like OPEX as well, which is this Friday. But, this is more about like in the next week, what's going to happen. And they're telling us that there's a lot of air under us right now. You have to be very careful.
Yeah, and look, Friday to Monday, there's a thing out there. Friday up, Monday up is kind of a thing. And then OPEX week, you start the week off strong. Tomorrow we can still have a green day, but don't the probability charts, Phil, tell us for the rest of February and actually into the next March contract for options, things get a little weaker?
Yeah, so seasonality is very bearish into the end of the month. And it's also more so when you have a pre-election year. So we're in a pre-election year for a primary election, and it's the same thing. You head down toward the end of February. So you got some compounding seasonal effects as well. So yeah, you added all that together and all the technicals under the hood, and you're pressing your luck for more to the upside versus you probably due for a decent pullback to kind of reset things at the very least. So yeah.
Yeah, so I think, guys, caution's the word. Look, energy's still working out, and we will have a boom video when and if oil, crosses over $82. Then I think you're going to see energy just actually spike and take off. Until then, everything's in Chop-O-Matic right now, and the market's due for a pretty decent pullback. So I'd be careful if you're trading. Cash is okay. If you're long term, the way I'm doing it now is anything that's not energy is going to cash for me. And there's some still selected cash energy names that are still pretty good to own with some pretty sweet dividends and pretty strong cash flows. And even oil and gas shippers are getting bids now too. So there's pockets of areas you want to be long, but primarily the market is due for a big pullback. And I don't know, Phil, you always tell me this, and you're usually right, is that even the good stuff sometimes don't survive a liquidity event sell-off. Basically, you sell what you can because you have to sell what you must. And so even the good stuff might go down in this move over the next 6 weeks.
Yeah, I think where that plays into things is like if you look at what happened from August into October, November, and look at all of the different sectors how they performed during that general sell-off. And I think and we're basically saying we're at risk for something similar here. But if you go back and you look at how things performed from August into November, we'll give you a pretty good idea of how they will survive if we get another leg down and test these lows from Q4. And I would expect it not to be any different. So just something to look at going forward from here.
Well, good. Phil, that's all I had for today. And tomorrow's CPI, so I'm sure we're going to be talking about that in our tomorrow's podcast. So thanks for listening.
Yep. Buckle up. All right, guys. Thanks for watching. We'll see you on the next one. Bye.
Trade Genius.